All right, let's dive right into a financial research report that makes a really bold call about Pakistan's stock market. It's forecasting some huge growth, so let's get straight to the big number. And the report does not mess around. The headline number, a projected 26% total return by 2026. Yep, you heard that right. And that's the kind of forecast that immediately makes you sit up and ask, wait, how on earth could that happen? Well, look, this isn't just a number pulled out of thin air. The report actually builds a very specific case based on three key interconnected drivers, and we're about to walk through all of them. So here's the game plan for this explainer. First, we'll look at that huge target number. Then we're going to dig into the major economic reforms that are supposedly fueling all this. After that, we'll see why investor money is shifting into stocks and check if the market is actually a good value right now. And of course, we have to look at the potential roadblocks before we wrap it all up with the final takeaway. Okay, section 1. Let's start with that big headline prediction, a 203,000 index target. Where does a number like that 26% return, actually come from? What's really interesting is how this forecast is pieced together. It's not just one thing. Think of it like a recipe with three main ingredients. The biggest piece of the pie, nearly 12%, comes from something called a P/E re-rating. That's just a fancy way of saying investors get more confident and are willing to pay more for a company's earnings. Then you add another 7% from companies just plain making more money. And finally, you top it off with 7% from dividends. Put it all together and boom, there's your 26% total return. Now, a prediction like that needs a solid foundation, right? It can't just be wishful thinking. And the report argues that it's all grounded in something very real, a series of major economic reforms that are fundamentally changing the landscape. So the report zeroes in on a few key triggers that are really powering this potential growth. They're finally getting a handle on this thing called circular debt in the energy sector, and we'll explain that in just a second because it's a huge one. They're also privatizing big state-run companies, earning credit rating upgrades, and getting much better at collecting taxes. You can think of each one of these as a crucial gear starting to turn in a much bigger machine. So what is this circular debt they keep talking about? Well, the easiest way to think about it is like a giant financial logjam. It's this massive chain of unpaid bills where one company can't pay its supplier because it hasn't been paid by its customer. It creates this domino effect that freezes up cash for some of the biggest companies in the country. And the key argument here is that these new reforms are finally starting to untangle that messy chain. And here's where we see the proof in the pudding. Evidence that these reforms are actually having an impact. This chart shows the country's tax to GDP ratio. It's just a measure of how much the government collects versus the size of the economy. And that jump you see, that's a huge sign that their efforts to get the country's finances in order are actually working. And here's even more proof. By dealing with that circular debt, these major energy companies are finally getting paid what they're owed. Their recovery ratios, which is basically the percentage of their bills they actually collect, have shot up from a really worrying 60 to 70% to now over 95%. This is huge because it means real, actual cash is flowing back into these vital businesses. Okay, so the economic engine is getting a serious tune-up, but that's only one piece of the puzzle, right? For the market to really take off, you need investors to buy in. And that brings us to the second major driver, a big shift in where people are deciding to put their money. This is fascinating. The report actually surveyed local institutional investors, the folks who manage the big money. They asked them a simple question. Will money keep moving out of safer fixed income investments and into the stock market? And look at that response. A whopping 68% said yes. That is a massive vote of confidence from the people on the ground. So why is this big shift happening? Well, the report describes a classic push and pull situation. On one hand, the stock market is pulling money in with really attractive features like a lower flat tax on profits. At the same time, other traditional places to park your money, like real estate or prize bonds, are kind of pushing investors away with new taxes and restrictions. It's making the stock market look like the most attractive game in town. So we've got reforms kicking in and we've got investors getting excited. But that leads us to the third, absolutely crucial question. Is the market actually a good deal right now? Or is it already too expensive? This is all about valuation. And to figure that out, we gotta talk about something called the PE ratio. Now, don't worry, it's pretty simple. It's just a way to measure how cheap or expensive a market is by comparing the stock prices to what the companies are actually earning. A lower PE number generally suggests things might be undervalued.
And remember that PE re-rating we talked about? Well, that's what happens when this number starts to climb.
And this chart just lays the whole argument out perfectly. The market's current PE is sitting at 6.8. The report compares that to a similar period of economic stability back in 2012 to 2015, when the average was 8.0. You see that gap? That space between the two bars is exactly what the report is pointing to. It's basically saying there's a lot of runway for growth, just to get back to a normal historical level.
And they don't just stop there. They double down on the valuation point with another metric, market cap to GDP. This just compares the total value of the stock market to the size of the country's entire economy. And what do you know? It's the same story all over again. The current level is well below its historical average. Adding even more weight to the idea that the market isn't overcooked, it actually has room to run. Okay, but let's be real. No investment story is all sunshine and rainbows, and any credible analysis has to look at the other side of the coin. So let's talk about the potential roadblocks that could get in the way. The first red flag the report raises is leverage, which is just a term for debt used to invest in the market. As you can see right here, the amount of borrowing is currently more than double its 9-year average. And while more debt can make the good times better, it can also make the bad times a whole lot worse. So that's a real risk to keep an eye on. But, and this is a really important but, the report immediately provides a crucial counterpoint. While the amount of debt is high, the cost of that debt is unusually low. The interest being paid is way below the 20-year average. So the argument here is that this cheap borrowing makes the high debt level more manageable, at least for now. And of course, there are the other big picture worries on the horizon. The report flags things like regional conflicts, the ever-present threat of climate events like floods, the fact that foreign investment is at a 10-year low, and any potential slowdown in the global economy. All of these are external factors that could definitely impact the market.
All right, so we've looked at the bullish case, we've looked at the very real risks. After weighing all of that, where does that leave us? What's the final takeaway from this whole analysis?
It really all boils down to a pretty straightforward 3-step argument. Step 1, critical government reforms are actually taking hold and fixing the economy's foundation. Step 2, because of that and because there aren't many other great options, local investors are moving their cash into stocks. And step 3, that market still looks cheap compared to its own history, which suggests there's plenty of room to grow. So in the end, this report lays out a powerful, data-backed case for optimism. It's a story of fundamental improvement meeting investor enthusiasm at a time of attractive valuations. But the ultimate question, the one we won't know the answer to until 2026, is this: will all of this powerful domestic momentum be enough to navigate the very real risks waiting on the horizon?